Welcome back. Time now for the board on Wall Street. Top investors watching your money. Joining me now is Citi's head of U.S. equity trading strategy, Stuart Kaiser. Also with us this morning is Lloyd. Stuart, great to see you. Thank you for joining the conversation.
Thank you. Good morning.
Luke and I were talking about markets earlier, which are under some selling pressure this morning, and I want to get your take on it in the middle of the beginning of earnings season. J.P. Morgan just reported the Dow's down 42. That's off of the worst levels of the morning, by the way. But J.P. Morgan just exceeded expectations with its fourth quarter number. Trading revenue exceeded expectations for the fourth quarter, but the bank did report a surprise decline in investment banking fees, missing its own guidance after a decline in debt underwriting revenue. The stock is up nonetheless, 1 2/3%. CEO Jamie Dimon says that the U.S. economy remains resilient with consumers while business conditions are holding steady. Bank of America, Citigroup, and Wells Fargo all will be reporting tomorrow. Investors are watching for signals on spending, delinquencies, whether earnings momentum carries into 2026. Stuart, how would you assess the J.P. Morgan quarter, and what are you expecting from fourth quarter earnings season this year?
Honestly, pretty positive. Jamie Dimon's been pretty negative about the economy for a couple of years now. So the fact that he's talking about resiliency, I think is very positive. The focus on consumer credit and consumer spending, I think, is the number one focus of investors going into this year. Some view that the big, beautiful bill is going to be very positive for tax refunds, that those tax refunds may be $1,000 higher than they were last year. So that goes directly into consumer credit, and it goes directly into consumers' kind of ability and willingness to spend. So I think it's a positive message. The year's off to a positive start, and I think any positive momentum from tax refund data in February is going to be really welcomed by the market.
So what is the other buzz on the trading desk right now in terms of where things going and in terms of what's most important to investors?
Look, I mean, last week we got a nice unemployment report. That helped. We'll get inflation today, which we're hoping will be pretty light and will be, another kind of benefit to the market. And then, you get into the Fed in a couple weeks. Obviously, a lot of political headlines on the Fed, but I think big picture, you have a Fed that's data dependent. So if the Fed is cutting rates, I think that's actually bad news for the markets because it's telling you that growth is under pressure. If you're sitting here today as an investor, you just got a very positive unemployment report. You've got a solid start to earnings, and you've got the prospect of a lot of stimulus hitting the system. So I think people want to be in cyclical equities, and they want to be long U.S. equities to start the year. It's actually been a nice start to the year. Obviously, we're only about a week in, but so far, so good.
By the way, the weekend matters, right? Isn't that the January effect? If the market does well early in January, that means it's going to be up for the year.
Hopefully.
Take a look at interest rates this morning, Luke, because investors are bracing for a busy week of economic data on top of all of that ahead of the Federal Reserve's first policy decision of the year. This month, the December Consumer Price Index is coming out with the yield on the 10-year right now up 2.5 basis points, sitting at a level of 4.20%. The CPI expectations call for an increase of 0.3% and an increase of 2.7% year over year. This is a delayed November Producer Price Index, and retail sales number is out tomorrow, offering a fresh read on inflation and consumer spending. Yep. Luke, are we going to see some noise in this number because of that government shutdown on the CPI this morning? What are you expecting?
Yeah, I think there could be definitely a little bit of noise, and some of the data is sometimes hard to trust. But what I do think is going to happen is, liquidity growth and inflation right now is still remaining really strong. I mean, growth remains strong, inflation's cooling, and liquidity remains very strong, like we talked about earlier. I think $8 trillion or so in money market accounts. So you saw the bank earnings, and the bank earnings actually tell you a lot. Loan growth is still there. The fact that they still are lending out money, and the investment banking revenues are down a little bit. That's kind of interesting. We're focusing on private credit. I think private credit and these private equity firms are competing with some of the bigger banks. So stock we own is like OWL, which is focusing on the private credit markets. But look, right now we're seeing the second, third derivative plays of AI come about, and that's keeping the economy very strong, GDP very strong. Government's pumping money into it. Companies are pumping money into it. And at the end of the day, data is the new currency. Whoever has the most data has the wealth, and that's what we're kind of seeing. That's why Google just passed over $4 trillion, right? And I think that trend's going to continue to happen, and that's why the higher beta stocks, we are higher beta right now. We are higher risk in our portfolios, and that's worked out very well this year. RSP, the breadth is widening. The RSP equal weight index is up 3%, and the market's up 1.5%. So that breadth is widening, and I think that trend continues to happen. It's very possible the RSP equal weight outperforms actually the S&P this year.
There are worries right now that somebody's going to be left holding the bag on all this lending on data centers. Do you share that concern?
Look, I think you have to break that into two pieces. I think if you look at the Mag 7 stocks, these are some of the cleanest balance sheets in the world. I don't think you're too worried about there. I think it's the second tier of companies that are a slightly lower credit rating that still have a lot of spending to do. So I think, to your point on second and third derivatives, Maria, your point, the AI trade calmed down a bit. People are taking a really critical eye right now on how much are you spending, what's the revenue growth associated, and what is your credit rating. If you look at Oracle, for instance, this is a BBB credit. It's seen a massive rise in credit spreads. A Meta can issue as much debt as they want without impacting the credit spread. So I think you're seeing kind of like a bifurcation here between the companies that have these pristine balance sheets and the ones that are really going to rely on borrowing to do that spending.
Yeah, I agree with you. And would you allocate capital right now to that space, to the AI space, or are these worries such that it could impact the markets as well?
Oh, I think you 100% have to have exposure to the AI trade. What we've really focused on is companies that are going to get a strong growth return on that CapEx spending. So again, you want to be in AI. It's an impossible theme to avoid, but you just want to be a little bit more critical and careful about how you're doing that right now.
Just some quick data points. GDP right now, 53.8% of U.S. GDP comes from the consumer pocketbooks. Salaries, wages. That's really the lowest since 1947. Profit margins are at 10.9% for companies, the second highest in history. And what that tells me is this AI trade is starting to really take effect, where AI is starting to increase productivity, increase margins, and starting to actually maybe hurt the little guy at home a little bit. So it's something we need to pay attention to as we head further. But the wealth separation, the rich are getting richer, and you have to partake by owning stocks.
All right, we will leave it there. Great to have you this morning, Stuart. Thank you. Thank you for those comments. Luke, you're with us all morning long, and we are grateful for that. We're going to keep following these markets, which, of course, are down about 50 points. Stay with us. We'll be right back.